Our next panel is on financial disclosure and accounting fraud, which is a real staple of this conference and a really important topic. So let me start by introducing our panelists from the SEC. Jennifer Calabrese is an attorney and a CPA at the SEC, and she's in the Los Angeles regional office. Jennifer, welcome. Nice to see you. Our moderator today is Lori Echavarria, a partner at WilmerHale in Los Angeles. She is a former SEC enforcement staffer of 15 years, where she was Associate Regional Director and Head of the Enforcement Program in the LA Regional Office. Great to have you with us again, Lori.
Thank you.
Very pleased to welcome Rebecca Lubens. She's Associate General Counsel at Ernst & Young in San Francisco and previously served for 9 years as an attorney in the SEC's Division of Enforcement. Welcome.
Thank you.
And finally, let me introduce Marty Wilczynski, a Senior Managing Director at Ankura. Marty has more than 35 years of professional experience in accounting, internal and forensic investigations as a consultant at an internal accounting firm, and also 6 years on the staff of the SEC, where he served in the Enforcement Division. His past experience includes more than 7 years as co-leader of the consulting team that provided the investigative and litigation support to the trustee and his counsel in the Madoff liquidation. Marty, great to see you. Thanks for joining us.
Thanks, Bruce.
All right, Lori.
Thanks, everyone, and thank you, Bruce. I'm glad to be here speaking about financial issuers and financial disclosure and accounting cases. This is an important area, and I think it's been interesting this morning to hear all of the discussion about cooperation, because I think this is one of the areas where cooperation actually can play the biggest swing vote, if you will, in how what the outcomes are for at least the issuer, probably not as clearly for the individuals. And as everyone heard in the panel, the directors panel, there's a lot of debate about what the weight of that swing vote and whether cooperation does in fact yield specific outcomes. But I do think this is the substantive area, publicly traded companies and issuers, where that comes into play. And it's a theme. We're going to try not to be too repetitive of all of the discussion that has already preceded us on cooperation. But I do think the theme of cooperation will come up as we talk about the different cases this year and the different matters this year and how the Commission is approaching this area. So let's start with you, Jennifer. I think everyone does always want to hear from the staff, and you focus much of your enforcement work on public companies and auditors. You are a CPA and an attorney, so bring both perspectives to that role. What are you seeing as the primary areas in which the SEC has been bringing cases related to public companies for accounting or disclosure violations?
I'll just give the disclaimer that these views are my own, and I'm not speaking on behalf of the Commission or the SEC staff. I'll start with financial fraud cases. Revenue recognition is always an area of focus for the Commission. This could be undisclosed side letters, accelerated or premature revenue recognition, or fake sales. Other financial fraud areas include unsupportable expense adjustments, reduction of accounting allowances, contingencies, undisclosed related party transactions, asset impairment, and also valuation issues. For disclosure matters, we've had a number of recent cases. In the Boeing company matter, the Commission alleged that the Boeing company and its former CEO made misleading public statements about the safety of the company's 737 MAX planes following crashes that occurred in 2018 and 2019. The company agreed to pay a $200 million civil penalty and the former CEO $1 million penalty to the harmed investors. The Vail case, that's already been previously mentioned on another panel, that was the Brazilian mining company and the collapsed dam. And I guess the third item I would bring up after disclosures is SOX 304. This is another significant area related to our financial fraud matters. Granite Construction, another person spoke about this on another panel. Separately from the financial fraud piece of the case, the Commission brought an AP against a settled AP against the company's former CEO and two former CFOs while not charged with misconduct, they collectively agreed to return over $1.9 million in bonuses and compensation to Granite pursuant to SOX 304. And then another example of SOX 304 is the Surgalign Holdings case and another financial fraud. And I'll note that this case came about from our earnings per share initiative, which uses analytics to uncover potential earnings management practices. So in the Surgalign case, one of the executives who was charged with misconduct and he settled, he agreed to return over $207,000 to the company pursuant to SOX 304. And then separately, 3 other former executives, while not charged with misconduct, agreed to return over $361,000 in incentive-based compensation to the company. So we see SOX 304 as a way to ensure accountability from executives and incentivize them to prevent this type of misconduct.
And I think this is a topic, clawbacks generally, and SOX 304 that we're going to come back to as we continue the discussion this morning. I mean, just setting the stage, and probably most people in the room know this, the original rule related to clawbacks that Jennifer has been referring to, SOX 304, has been around since the enactment of Sarbanes-Oxley in the aftermath of Enron and WorldCom, and it requires an issuer to obtain clawbacks from the CEO and CFO of any incentive-based compensation after a restatement involving misconduct. And I think in a little bit, we're going to talk about the expansion of clawbacks and interest in the expansion around clawbacks to go beyond the scope of that rule. But first, I want to talk about the increased focus on individuals that we've heard mention of to some extent earlier during the day, particularly from the director at lunch. So how has this been going? How does the increased interest in individuals come into play related to issuer cases, financial disclosure and accounting cases? And how does that contribute to a possible kind of increase in litigation because of the stakes for those individuals?
So the short answer, I think, is that as we go into the upcoming year, that you'll probably see more individuals choose to litigate. And I was on the SEC staff. I left there in 1998, so 25 years or so ago. And I know there's a lot of SEC alumni here today. It's interesting to me over the years that if you talk to any alumni, they always feel like their time on the staff was when the SEC was the most reasonable and and easy to deal with in history, regardless of when it was that they were there. I certainly felt that way. But when it comes to recommending a charging decision or what a fine might be, it goes to conversations and strategy. And you heard Gerbir today and last year talk about ramping up the penalties and the like. And in terms of individuals, like anything else, it really comes down to the settlement negotiation and the deal that's on the table. And I think there's a consensus amongst the white collar and securities bar that right now dealing with offers from the SEC is as difficult and as rigid as it's ever been. The offers are very frequently, take it or leave it type offers. And they really, go to the 2 or 3 principal areas that are important, which is what are the charging decisions? Is your client, the individual or the company going to get charged with fraud or a non-fraud charge, a books and records charge? There's different ways and interpretations with what come with each of those. The civil money penalty that may be attached to the settlement is obviously a big factor. And thirdly, you have reputational factors and how disruptive a litigation is going to be to your company or B, your life. And so everybody has to weigh those factors. We've seen a few cases pop up recently where the SEC is going after individuals. Jennifer mentioned Surgalign, which is a pretty straightforward, garden variety pull forward case, a revenue recognition case. There was also a case filed against 3 executives at Austell USA which again was not a particularly innovative accounting matter. It was a percentage of completion case that the individuals chose not to settle, and so the commission's going to take it to court. So those are all things that I think as individuals are given offers that look and sound and appear to be take it or leave it, where the penalties are increasing markedly. You can probably expect that more of them will do the calculus and figure out what's best for them and decide to litigate and take their chances there rather than settling for what they might perceive as being an overly aggressive offer from the staff.
Agreed, and I would just note that we are also seeing, individuals litigate for a period of time and then ultimately come to the table and settle. Like an example is in McDonald's, the CEO ultimately settles for a 5-year O&D bar and a $400,000 penalty, but I think there was some litigation along the way, including about his clawback amount of almost $53 million that the company that McDonald's sued him for. And so kind of moving down closer to me, Rebecca and Jennifer, are you seeing an increased pressure on audit firms related to the current SEC climate? We heard from Gerbir earlier that the focus on gatekeepers continues, and we've heard a bunch about the EY case, which we're not going to focus on in this panel as much, but other types of issues against gatekeepers.
Yeah, so I need to start with my disclaimer that the views I express are my own, not those of Ernst & Young. But in my view, for audit firms and auditors, it is a demanding regulatory and enforcement environment out there. Starting with the SEC numbers, looking at audit and accounting related cases, numbers are obviously ticking up. They're still not quite where they are in terms of filings, as they were in the pre-pandemic era. But I think, we all know these cases take 2, 3, 4 years to work their way through the system. And I think I predict we will certainly see more filings in that area. I think there have also been a number of statements from the chief accountant, Paul Munter, touching on enforcement themes rather, and others from OCA, including recently at the ALI Accountants Liability Conference, the chief counsel, which is somewhat unusual for OCA to be, commenting on enforcement themes and enforcement cases. So I view that as a data point that's important. The audit firms, of course, are also regulated by the PCAOB, and there as well, Chair Williams has been explicit that, she is, under her leadership, the board will be approaching enforcement with a renewed vigilance, I think are her words, and the fiscal 22 numbers certainly bore that out. They brought, twice as many enforcement actions last year as they had the year before, and recovered more monetary penalties than they ever had in any year of the board's history. And then on top of that, I predict we'll see some challenging dynamics that in the next few years that make this a tricky space to navigate if you're an audit firm or an auditor. One is, I think, that we will see increasingly concurrent jurisdiction exercised by the SEC and PCAOB in investigations. And while that is, obviously envisioned by SOX, it's not something that we always saw in the past, where we would often see one regulator defer to the other on a particular investigation, usually the PCAOB to the SEC. Now I think we will see more investigations where you have both regulators looking at the same audit or the same issue related to an audit firm system of quality controls, and then concurrent, sort of joint or consecutive filings. I think we'll also continue to see increased use by the SEC of prospective remedies in the form of undertakings and monitorings, and perhaps restrictions that go beyond the more traditional imposition of an independent compliance consultant and, expands to more aggressive measures like client bans or, I think what the staff would consider remedies that are more tailored to the misconduct being alleged in a particular case. And then finally, I would predict, at least as for the audit firms and auditors, but really like so many other participants in the capital markets, we will see more investigations starting as not as a suspected underlying violation, but as a sweep. And we heard today that the SEC intends to use more of those. And I think as a result, we will see more cases coming out of that maybe, at least as for the audit firms, may have sort of ended in the past with the PCOB inspections program, but now will be, quick cases with little investigation, starting sort of, alleging strict liability or very technical violations.
And Jennifer, do you have any trends that you've kind of been observing in this space as well?
Well, of course, auditors are always important to us as gatekeepers. So last fiscal year, so that's the ending September 30th, our work in this area resulted in 45 accountants and audit firms being barred or censored under the Commission's Rule 102E. I'll highlight two cases for you. One is Deloitte China. The Commission alleged that Deloitte China asked its audit clients to audit the client's own work, such as asking the client to select its own audit samples for testing and prepare audit documentation. So the audit firm, agreed to extensive remedial measures and to pay a $20 million civil penalty. And another case that Michelle mentioned, this is a case that came out of the LA office, the Mattel, toy maker Mattel case. In that case, we also charged the former audit partner on the Mattel audit. The Commission alleges that the former audit partner failed to comply with multiple PCOB standards, including his failure to verify that an uncorrected tax expense error was documented despite knowing of it, and failing to communicate the error to Mattel's audit committee. In a second piece of that case, the Commission also alleges that the former audit partner violated auditor independence rules by providing prohibited human resources advice to Mattel, including suggesting to Mattel's then CFO which candidate would be the best fit for a position at the company, and as well as who should not be hired.
And so it's interesting to hear that number of cases that are being 102Es that are being brought against accountants, and those types of specific accounting framed matters being brought against accountants. And it makes me think about a question I get from clients a lot in this space, which is, does the enforcement staff work with accountants? Do they know what the accounting guidance is? Do they have experts who are able to tell them what these rules mean? Or am I just hearing this from a lawyer who is in a regional office or even the home office without guidance? And so we thought it might be helpful to talk for a moment about the engagement of accountants in the work of the enforcement division and the regional offices, and to come back to something that Rebecca noted, which is the increased role of OCA speaking publicly about some of the work that enforcement is doing. So Jennifer, let's start with you. You're both an accountant and attorney, so you would be able to address the first stage of my client's question, which is, do they have someone who knows the accounting rules? But what is the role of the other divisions within the Commission in advising on accounting matters, and particularly when you're looking at charging accountants or bringing a 102E? And how does enforcement coordinate on those matters?
We consult with Enforcement Office of Chief Accountant, otherwise known as OCA, and also the Commission's OCA on accounting, auditing, Rule 102E matters. Ryan Wolf, he is the head of Enforcement OCA. He came back to the Commission about 9 months ago. So we consult with him. Charles Wright, he's Senior Legal Advisor in Enforcement OCA. We consult with him, with the two of them early and often during our investigations. And then, of course, we consult with the Commission's OCA. And the Commission's OCA also has technical experts in their professional practice groups who we can reach out to.
And just to break that down, so there's accountants that you're considering OCA within enforcement.
Right.
The office, the chief enforcement accountant, if you will, and then there's the office of chief accountant, which is the division that reports to the commission, but also, and advises them on accounting matters, but also advises enforcement and has subject matter expertise.
Exactly.
And both are brought into enforcement cases early and often.
Early and often, yes.
Great. And so, Martin, I think you had observed some other kind of recent commentary from OCA and involvement, and had experience with the involvement of OCA from your own time at the commission.
Sure. So, as it relates to registrants and auditors in public companies, the financial reporting and periodic filings really intersect with three principal parts. We've got corporation finance, which looks at the filings and kind of reviews them for adherence to accounting and disclosure rules. You've got OCA, who sets the accounting agenda and is ultimately responsible for any accounting related, reporting related matter that's before the commission in their role of the federal securities laws. And then you've got enforcement. So those three groups, and this has been consistent for many, many, many years, those three groups interface and work together closely on all accounting matters, and those go to enforcement matters certainly. Some of it relates to the personalities of the chief accountants who are in those different roles. Over the years, there have been some chief accountants in enforcement who have been very, very aggressive. Others, maybe a little more hands-off. I can say that I think having Ryan rejoin the commission as chief accountant, replacing Matt Jakes, who was there before him, when there are those lulls between chief accountants, at least from my perspective, you can see the throughput and the amount of engagement, cases being brought, et cetera, really kind of slow down a little bit. When Ryan came in, I think the pace, it seems like it's picked up a bit. There's, I think, more coherence, more direction, and that's been the same as well. Paul Munter, who's the chief accountant of the commission now, he's very, very, very strong technical accountant, and I think he's got some, views and expectations which he's expressed in speeches, regarding what is expected out of, registrants and individuals who are involved in the public reporting process. And the same thing with Corp Fin. I mean, Corp Fin has a chief accountant. They're on the ground. They're active in things like sweeps, looking at adherence within industries, and checking, to make sure that accounting rules and disclosures are being applied consistently amongst industry groups. So they all play important parts. Gerbir said in his comments just a bit ago, he was talking about covering the waterfront, and he's absolutely right in that there are, extremely talented and bright people within all of these accounting groups within the commission, enforcement, Corp Fin, and OCA, that really understand, complicated accounting and can apply it and advise on it, so that every case that gets brought up, has resources that are able to apply themselves to those different matters. There is a lot of dialogue. Right now, I think the way it's headed is that OCA seems to be more active than some of the prior chief accountants in terms of being out in front of the enforcement topic in the enforcement area. So I think we can look for that to probably continue, which will likely mean more actions and more sort of demands upon the people who are responsible for signing the opinions and filling out the filings and filing them with the commission. They're all things that kind of intersect when it comes to the accounting and reporting area.
And so I had promised earlier, and I know everyone's been waiting, for me to come back to clawbacks, and clawbacks have become, I think, a part of the cooperation conversation that we've been having kind of all day here, but also just part of the conversation at the SEC and the Department of Justice, with the Department of Justice's new policies that came out recently, in which they actually expressly note that they will consider clawbacks as part of their fine assessment process. And so around all of this, there's a lot of renewed action focused on issuers requiring clawbacks of compensation from executives. We talked earlier about Sarbanes-Oxley 304, which is the rule that requires it. You heard, if you were in the room, Michelle talk about it's a rule, it requires it. Why would we question whether or not to apply it? And that is what is the minimum bar that is required in a clawback. So it would be CEOs, CFOs, restatement of and it affects incentive compensation, and misconduct has to be part of it. But now we're starting to hear more broad applications of clawbacks. We're starting to see rulemaking around and new rules requiring the expansion of clawbacks. And so this seemed like an area that would be worth talking about, as I think it is going to continue to be a focus for issuers in the coming year. So Rebecca, let's start with talking about kind of some of what's been going on related to new rulemaking on clawbacks, and how that and how the SEC has talked about clawbacks in connection with some of its cases involving cooperation points.
Okay, so as many of you probably know, there is a new Exchange Act rule out there, 10D1, which directs the national securities exchanges to establish listing standards requiring all listed companies to adopt and comply with clawback policies with certain requirements. The clawback policies need to provide for the recovery of incentive-based compensation from current or former executive officers in the event the issuer is required to prepare an accounting restatement. The incentive compensation needs to be recovered for the 3 fiscal years preceding the date on which the company is required to prepare the accounting restatement. And the rule is, as everybody probably knows, also significantly broader than SOX 304 in that, number one, it is triggered regardless of whether it is a big R or little r restatement. 2, regardless of whether the restatement is triggered by misconduct. And 3, it's unclear who exactly it applies to. I think it just says, executives and officers, but it appears to certainly be broader than the CEO and CFO, which is what SOX 304 requires.
Yeah, it's current or former executive officers, so it's pretty broad and seems to leave a fair amount of room. I mean, it could be defined as Section 16 officers, but it's not necessarily clear that that's a limitation.
And then, it's hard to say where we are. The rule's not effective yet, but, I think as Lori mentioned, it certainly seems to be that this is, clawbacks are being obtained more broadly and earlier and sort of proactively more often. I thought one case that was worth mentioning that sort of plays into the cooperation conversation that hasn't been mentioned today is the CHS case from September 2022. That's a no penalties case. It was a non-fraud resolution charging books and records, internal accounting controls, and certain reporting violations. There was also no undertakings. It was the basic facts were this was an agricultural cooperative that entered into contracts with railroads to transport freight contracts. There was a trader who manipulated the contracts that led to misstated financial statements and a restatement. And the press release called out and the order called out in significant detail the company's cooperation and remediation. But among the remediation measures was that the company had sort of proactively clawed back incentive compensation from 26 current and former officers and directors. Unclear, if that included the CEO and CFO, but it certainly seems like this may become more of a standard sort of component of settlement packages or expected cooperation, in my view.
And I've also heard more from clients questions in the last year or so about how to think about internal clawback policies, voluntary, as part of their corporate compliance program or as part of their corporate governance, to have internal compliance or clawback programs that expand the scope of the officers beyond executive officers, that can involve a whole list of itemized positions within the company who would be subject to a clawback if the conditions are met. And then the conditions are not just accounting restatements, but also sometimes other types of reputational harm to the company, litigation harm to the company, ESG related harm to the company. There are a lot of issuers who are thinking about issues outside of just accounting to apply clawbacks, involuntary internal policies. And it seems that the recent corporate guidance from Department of Justice and the SEC cases acknowledging cooperation where expanded clawbacks are obtained will continue to feed into some of that thinking by issuers as they look at how to think about clawbacks for their own within their own company. I also would note the McDonald's case, where McDonald's was given cooperation credit for suing the CEO to get back the $53 million from him. And so further to this notion that issuers are being incentivized to really move clawbacks into their compliance and compensation program in a more aggressive way. And I have heard a lot of questions from people and interest from people, from clients in that area. So I do think this is going to be a space where things continue to expand. And so kind of moving on from clawbacks again, we've also seen, but other types of financial issues or penalties that issuers can face when these cases come around. I wanted to talk a little bit about what we're seeing in terms of penalties. And there has been a lot of discussion about penalties and cooperation already today, but I'll just ask for Martin to comment on thoughts around charges against issuers that are not scienter-based, but where the penalties assessed in the settlements were significant, and what kind of the trends look like in that area, in that space.
Yeah, so we talked a little bit at the beginning of the program here about negotiations and offers being made to settle out matters with individuals or registrants, and those again go to a few factors. One important one being, what am I going to get charged with? And nobody wants to get charged with fraud and have that hanging over them. And in particular, no one wants to get charged with scienter-based fraud, section 10B, 10B5. And in looking at the sort of the activity in the last year or so, year to 18 months, it looked from a review of the accounting and enforcement releases, which are typically generated upon completion of an accounting or financial reporting case, that there were more 17A 2 and 3 cases vis-a-vis a 10B charge than there had been in the past. And if you look at some of those orders, the description of the reporting violations, of the misaccounting, of the different factors that went into the body of evidence that made up the basis for the order. It's hard to differentiate in some cases why those particular cases were not brought as 10B cases. I know there's a million facts and circumstances that go into every single one of these matters, so I'm not second guessing. Just observing that, it seemed like there were more 17A 2 and 3, which are non-scienter based anti-fraud charges than there had been in the past. But to look at the penalties that were associated with those same matters, you'd never know that they weren't full-bore, scienter-based accounting fraud cases. Going back is a handful of examples. In March of 23, just a few months ago, DXC, which was a matter involving non-GAAP metrics, They settled out to a 17A 2 and 3 charge is kind of the headline, and all of these are 17A 2 and 3 cases. But DXC settled out for a civil money penalty of $8 million, which is real money. In September of 22, Compass Minerals, which was brought up on 17A 2 and 3 regarding disclosure control failures, they settled for a penalty of $12 million. VMware, also in September 22, were basically charged with delaying deliveries, managing earnings, via the sales that they were putting through in kind of a selective way. They settled for $8 million. Eagle Bank Corp, August of 22, it was disclosure issues regarding related party loans. Same charges, a $10 million penalty. Rollins was a earnings management case, $8 million penalty. And then Baxter in February of 22 was an $18 million settlement. So the fines in these matters are really substantial. And again, that shouldn't come as a surprise to anyone. Again, we heard Gerbir announce that was part of the plan, that he felt that was a way to deter misconduct in a continuing fashion. And so, in one respect, we're getting exactly what we'd expected, but the differences of what's associated with different kinds of charges. Usually the 10B charges are the ones that garner the largest penalties. That seems to have shifted around to where now, whether it's a books and records case. I mean, there was a books and records case brought recently against Gentex regarding accounting for some bonus compensation. It was a 13A case, a 13B, 2A and 2B, and a 13B5 case. So there wasn't any fraud charges included in that one at all. And they settled to a penalty of $4 million, which, again, for a books and records charge is pretty substantial. So the overall charges, or the overall penalties, Gerbir mentioned on the last panel, in 2020, the penalties were $1.1 million. In 21, they were $1.4 million. And last year in fiscal 22, they were $4.2 million. I'm sorry, $4.2 billion. Missed a letter. But yeah, so 1.1 billion, 1.4 billion, 4.2 billion. So it's really kind of a quantum leap this past year. And I suspect, again, based on the discussion today, that that's probably going to continue. And that's something, Lori, that clients will have to kind of contend with, knowing if you're in that position where you have to be negotiating a settlement, you better bring your checkbook, because it's going to be a big number.
Yes, I think that is the message that I think was the division has intentionally set out to create. And it does, as I had said at the beginning, there's themes of cooperation that get woven through some of this discussion, because the increase in penalties should relate to the discussion about cooperation, in that the primary carrot that we've always been told, and that the directors panel also discussed, is a decrease in penalties or no penalties for cooperation. So it somewhat begs the question of, on these cases where there are non-scienter based charges, maybe there's no individuals even being charged with anything in some of those cases, I'm pretty confident. So it's a kind of corporate books and records, internal controls type of case, but they have a multi-million-dollar penalty. Where does cooperation fit in? And should cooperation be playing that heavy of a lift on ratcheting up a penalty to something that's a very high number, or bringing a penalty down to something that's a lesser number? It certainly feels like it may be playing a heavier lift than the conduct itself, based on what you're describing, Martin. And so I think it's just an interesting theme to think about, and certainly issuers and their counsel have to think about that as they're coming into this. It may not be that you would assess the risk of an ongoing investigation into accounting fraud by thinking about, well, this is just a books and records issue. We made a mistake. There's no individuals who are culpable, so this shouldn't be that big of a deal, right? It may be that actually you need to be self-reporting it and cooperating, or else it is going to become a very financially big deal, even if the charges are somewhat limited in scope. And so that is a difficult thing for companies to assess or to gauge, and particularly where you may miss the opportunity to self-report. If, as the whistleblower panel talked about, if a whistleblower beats you to the punch, you may just not have that as a tool in your cooperation. You may be deprived of that choice. So it is a tough area for issuers, I think, who find themselves with an issue, an accounting issue. And the opportunity to manage the cost of resolving that issue may be fairly narrow. I want to talk a little bit about something else that's coming out of this, which is the rise in disclosure cases and disclosure cases as a standalone. It seems that there is much more of an increased focus on disclosures and on disclosure controls cases. So Jennifer, what are disclosure controls as a primary basic question?
Well, someone mentioned this on another panel. It's disclosure controls and procedures are required under Exchange Act Rule 13A-15. And so what issuers need is they need the appropriate disclosure controls that gather the information for management, give it to management, and management can assess, well, does this need to be disclosed? And it could be developments in the business, or could be risks that need to be disclosed to the investors.
And so, Rebecca, how is that coming out in some of the cases that we're seeing? How is that being used?
Well, I think, it's been alleged in DHX and a number of the cases that Marty mentioned. I think another case that's been mentioned a few times today is Activision. As we've heard, the company had risk disclosures per the SEC's order. The company had risk disclosures indicating that attracting and retaining a skilled workforce was important to its business, and then was charged, in addition to 21 F17, with a 13A-15 violation for not having disclosure controls and procedures that ensured information relevant to those risk factors made its way to management. To me, the interesting thing about that case was that the SEC did not allege that the disclosures were actually inaccurate, that, sort of related to these risk factors, or even that information related to workplace misconduct was actually relevant to recruitment and retention of employees, which is sort of how they got back to the risk factors. And picking up on the theme Marty highlighted, that was those were the only two charges, and that was a $35 million penalty.
And so I know also that sometimes these disclosure control cases can raise differing views by some of the commissioners. And so quickly, in our last remaining minute, Marty, do you have any thoughts about the differing views that some of the commissioners have expressed related to some of these disclosure-only types of cases?
Hester Peirce is been active, I think, you could say, in terms of some of the dissents and statements that get put out after certain of these cases, and Activision was definitely one of them. Echoing, the Rebecca's comments, the surprising thing, I guess, was that nothing in the order, actually said that the risk disclosure was at any time misleading. And despite it not being misleading, there was still a $35 million penalty and settlement to this 13A-15, which had not been a really common charging section, I think, in the past. And so there's a little bit of leeway, I think, there, and probably a little bit of ability to broaden out and send a message of what the commission expects registrants to be looking at. And we're looking at Bruce.
Yep.
Thank you.
Well, thank you, everyone. Thank you, guys.
Thanks. Great job.